Welcome to the Deep Dive. Today we are tackling, well, probably one of the most stubborn ideas in all of economics.
I think I know the one you mean.
It's that phrase you hear everywhere, from cable news to your uncle at Thanksgiving. Printing money causes inflation. Full stop.
Right. As if it's a simple one-to-one relationship, an immutable law of nature.
Exactly. But is it always true? I mean, how do the experts, from the classical thinkers centuries ago to, the modern rebels, actually view this high-stakes game?
That's the million-dollar question, isn't it? That simple phrase is both profoundly true in some very specific, extreme circumstances, and it's also completely misleading in others.
So that's our mission for this deep dive. We're going to unpack that paradox.
We are, and we've got a fantastic stack of source material to do it. We're going to go from the foundational math of the quantity theory of money to the radical challenges of something called modern monetary theory.
And then into the real world, right?
Yeah.
Looking at policies like quantitative easing.
Yes. And finally, the devastating proof of what happens when things go cruelly wrong, with a case study on hyperinflation in Venezuela.
So here is the core question for you, our listener, to keep in mind throughout all of this. When is that old rule, more money equals higher prices? An absolute, undeniable fact.
And when is it, well, a dangerous oversimplification that could lead us to misunderstand how the economy's hidden gears actually work?
It's a huge topic, so I guess where do we even begin?
We have to start at the beginning, with the bedrock of this whole idea.
The quantity theory of money,
Yeah.
QTM.
Exactly. It's arguably the oldest surviving theory in economics. The basic idea goes back centuries.
How far back are we talking?
We're talking 16th century. You had thinkers like Copernicus, yes, the astronomer, and Spanish scholars like Azpilicueta and Bodin. They saw all this gold and silver flooding into Europe from the New World.
And they saw prices in Spain going through the roof.
And they made the connection. More money chasing roughly the same amount of goods meant prices had to go up. It was an observation, a powerful one.
But it wasn't a formal theory yet. Not with, equations and assumptions.
Not yet. That really came much later. The formalization, what some call the golden age of the quantity theory, happened in 1911 with the American economist Irving Fisher.
And Fisher gave us the famous equation.
He did, though to be precise, he started with what's called an identity, the equation of exchange. MV equals PT.
Okay, let's break that down piece by piece because this equation is the foundation for everything else we're going to discuss. So M
is the money supply, the total stock of money in the economy. Simple enough.
P is the general price level, an average of all prices.
Right. And T is the index of the real value of all transactions. You can think of it as the total volume of stuff, goods, and services being bought and sold.
Okay, so we have money, prices, and stuff. But then there's V, the velocity money. That one always felt a little abstract to me.
It is abstract because it's a derived variable. You can't just go out and measure it. V represents the average number of times a single dollar or whatever currency is used to buy final goods and services in a period.
So how fast money is changing hands?
Exactly. And the reason MV equals PT is an identity is because it's always true by definition. V is literally calculated as PT, the total value of spending, divided by M, the amount of money.
It's a bit like saying distance equals speed times time. It's just a way of defining the relationship. So how does a definitional identity like that become a powerful, predictive theory of inflation?
That is the crucial intellectual leap. To turn it from an accounting identity into a theory, you have to make three, and I mean very strong, assumptions.
And classical economists believed these assumptions were, for the most part, true.
They did, certainly in the long run. Let's walk through them.
Okay, assumption number one.
First, they assumed that the volume of transactions, which we can simplify to Q for real output, is fixed.
Fixed. Why would they assume the amount of stuff an economy produces is fixed?
Because of a concept called Say's law. The classical view was that the economy automatically tends toward full employment. If you have idle workers or factories, wages and prices will adjust to put them back to work. So the economy is always producing at its maximum potential capacity.
So if the economy is already at full throttle, you can't increase Q. You can't make more stuff just by adding more money.
Precisely. Any change in the money supply can't affect real output. It can only affect prices. That's a huge assumption.
Okay, what's the second one?
The second assumption is that V, the velocity of money, is constant, or at least stable and predictable.
And the logic there.
They believed V was determined by deep, slow-moving institutional factors. Things like, how often do people get paid? Once a week, once a month? How efficient is the banking system? The fundamental payment habits of a society.
Things that don't change overnight.
Exactly. They change over decades, maybe. But in the short to medium term, they treated V as a fixed number.
Okay, so output is fixed, velocity is fixed. What's the third and final piece?
The third assumption is that M, the money supply, is controlled by the central bank. It's an external or exogenous variable that the monetary authority can set as it pleases.
So if you put all three of those together,
The conclusion is inescapable. If T is fixed and V is constant, then any change in M must cause a direct proportional change in P,
double the money supply.
and you double the price level. It turns inflation into a purely monetary phenomenon. Money is neutral in the long run. It only affects prices, not the real economy. That right there is the intellectual origin of the cliche we started with.
But what's so fascinating is that almost as soon as Fisher laid out this very mechanical view, another group of economists came along and looked at the exact same problem from a completely different angle.
A completely different, and you could argue, much more human angle.
This was the Cambridge School.
Right. They were talking about giants like Alfred Marshall, A.C. Pigou, and critically, a pre-general theory, John Maynard Keynes. They weren't focused on how fast money was circulating. They asked a different question.
They asked why people hold money at all.
That's it. They focused on money demand. Their equation looks similar, but the thinking is worlds apart. It's MD equals K times P times Y.
Okay, so MD is money demand. P and Y are still prices and income. But what is this K factor?
K is the key. The Cambridge economists argued that people choose to hold a certain proportion, K, of their nominal income, in the form of cash. It's about a conscious choice.
A choice to hold on to cash instead of, say, investing it in bonds or stocks that would earn a return. Why would they do that?
For convenience and security, they called this liquidity preference. You need cash for day-to-day transactions, and you want some on hand for emergencies or unexpected opportunities. So K represents your desire to hold liquid cash.
So if people are really nervous about the future, they might want to hold a lot of cash. Their K would be high.
Exactly. And if K is high, what does that mean for velocity?
Well, if everyone is holding onto their money, it's not changing hands very quickly. So velocity V must be low.
Precisely. Mathematically, K is just the inverse of V. So if you set money demand equal to money supply in equilibrium, the Cambridge equation and the Fisher equation are, on paper, equivalent.
But the conceptual shift is massive.
It's a chasm. Fisher's theory is about the plumbing of the economy, the pipes and the flow rate. The Cambridge approach is about psychology. It's about human behavior, choice, and expectations about the future.
And that one little variable, K, the desire to hold cash.
That's the seed of the entire Keynesian revolution, because Keynes would later argue that K and therefore V was anything but constant. In a crisis, it could change dramatically, and that simple fact blows the whole classical theory out of the water.
So that feels like the perfect pivot point. If the classical QTM is our starting point, the work of John Maynard Keynes is the first and maybe the most significant historical challenge to it.
It really is. And it's all built on attacking those rigid classical assumptions. Keynes had this famous and very sharp retort to the classical focus on the long run.
In the long run, we are all dead.
Exactly. He was saying, your theory might be true in some abstract future, but people live, work, and suffer in the short run. And in the short run, your assumptions just don't hold.
So let's take them one by one. He first went after the idea that output, Q, is fixed.
Yes. The classicals assumed full employment. Keynes looked around during the Great Depression and said, are you kidding me? He argued that underemployment and idle capacity weren't just temporary glitches. They could be a persistent, stable state for an economy.
So let's run the thought experiment. You have an economy in a deep slump. Factories are running at half capacity. Millions are unemployed. What happens, according to Keynes, if the central bank injects a bunch of new money into that system?
Well, in the classical model, it would go straight into prices. But Keynes said no. In an underemployed economy, that new money affects Q, real output, first.
Oh, what's the mechanism?
The new money pushes down interest rates. It becomes cheaper for businesses to borrow and invest, so they might decide to build a new factory or restart a dormant production line.
And to do that, they have to hire those unemployed workers.
Right. Those newly hired workers now have an income. They go out and spend it, which creates demand for other businesses who then hire more workers. You get a multiplier effect. Real production increases, Q goes up, and you get economic growth.
All without triggering that one-to-one inflation the QTM predicted.
At least not at first. Keynes acknowledged that as the economy gets closer and closer to full capacity, you start to hit what he called bottlenecks. You run out of skilled labor or key materials. At that point, yes, further injections of money will start to push up prices. P more than output, Q.
So the effect of money on prices is conditional. It depends entirely on where the economy is in the business cycle.
Precisely. And that brings us to the second assumption Keynes attacked, the constant velocity of money, V.
The classicals thought V was fixed by stable institutions. Keynes saw it differently.
He saw it as being driven by psychology, by fear and uncertainty. He called it the liquidity trap.
What happens in a liquidity trap?
Imagine a deep crisis. The central bank can pump trillions of dollars into the banking system, increasing M. But if businesses are too scared to invest and people are too scared to spend, they just hoard the cash.
Their Cambridge K factor goes through the roof.
To infinity, almost. They prefer the safety of cash over any investment, no matter how low interest rates go. So the velocity of money, V, plummets. It grinds to a halt.
So you have a massive M, the money supply, multiplied by a tiny, tiny V.
And the result is that total spending, MV, doesn't change much at all. The money is just sitting there dormant. The link between M and P is completely severed by human psychology.
This sounds eerily familiar. This is the exact debate we had around the pandemic, isn't it?
It's a perfect modern case study. In 2020, central banks around the world unleashed a historic wave of monetary and fiscal stimulus, a massive increase in M.
And the QTM purists were screaming from the rooftops that hyperinflation was just around the corner.
They were. But it didn't happen, at least not right away. Why? Because we were in a Keynesian world. The economy had massive idle capacity from the lockdowns, and crucially, velocity collapsed.
People got stimulus checks, but they were uncertain about their jobs in the future, so a lot of it went into savings, not spending.
Exactly. The money was created, but it wasn't moving. M was huge, but V was incredibly low, no immediate demand pull inflation.
Okay, but then we did get a huge wave of painful inflation in 2021 and 2022. So if it wasn't the initial money printing, what was it?
This is where we have to get nuanced and distinguish between two types of inflation. There's the classical demand pull inflation, too much money chasing too few goods.
And then there's cost push inflation.
Right. And the source material argues compellingly that the 2021-2022 wave was overwhelmingly driven by cost push factors, by massive global supply shocks.
Give us some examples of those shocks.
Oh, the list is long. You had the global logistics network just seize up. The cost of shipping a container from Asia to the U.S. went from maybe $2,000 to over $20,000, which is an insane increase in the cost of every single imported good.
It is. Then you had the semiconductor shortage, which crippled production of everything from cars to washing machines. Energy prices soared because of geopolitical events and supply chains struggling to get back online.
So the cost of all the basic inputs for production, energy, materials, shipping went up dramatically.
Right. And businesses had no choice but to pass those higher costs on to consumers in the form of higher prices. This is cost inflation. Now, did the earlier stimulus money make it easier for people to pay those higher prices?
Absolutely. It added fuel to the fire.
It definitely amplified the problem.
Yeah.
But it wasn't the sole or even the primary trigger. The trigger was the supply side of the economy breaking down.
And this distinction between demand pull and cost push becomes even more critical when you look at developing economies.
It's night and day. Let's take an economy like Turkey, which the sources mention. It's heavily dependent on imports for energy, raw materials, pretty much everything it needs to run its factories.
So in a country like that prints money, what happens? Two things happen, but on very different timelines. The first is the classical demand channel, where more money in people's pockets might eventually lead to more spending. But that can be slow.
What's the second, more immediate channel?
The exchange rate. When a central bank in a developing country rapidly expands the money supply, international markets lose confidence. The value of the local currency, the lira in this case, tends to depreciate sharply.
And a weaker currency means all those necessary imports.
It instantly become more expensive in local currency terms. The cost of oil, steel, plastic, machinery, everything your industries need to function shoots up overnight.
So in this context, the act of printing money doesn't just boost demand, it directly and immediately boosts costs.
Exactly. The money supply itself becomes a cost factor. It fuels cost-push inflation instantly through the exchange rate, even if domestic consumer demand is still weak. This is a dynamic that the simple QTM model completely misses, and it's why managing inflation in these economies is so incredibly complex.
Okay, so we've established the classical view and the Keynesian challenge. It feels like the ground is shifting constantly. But now we have to talk about the most radical new idea on the block, modern monetary theory, or MMT.
Right. And MMT doesn't just challenge the assumptions of QTM, it almost throws the entire rulebook out the window, especially when it comes to government debt.
What is the core, central claim of MMT?
It's simple and on the surface, very appealing. MMT says that a government that is sovereign in its own currency, meaning it borrows in a currency it can create, like the US with the dollar or Japan with the yen, can never be forced to default on its debts.
Because it can always just print more money to pay the bills.
In essence, yes, it can always create the necessary currency to meet any obligation, whether that's paying interest on bonds or funding massive government programs.
So for MMT proponents, the constraint on government spending isn't the budget deficit or the national debt.
No, they argue the only real constraint is inflation. If government spending pushes total demand beyond the economy's ability to produce real goods and services, if you run out of available workers, factories, and raw materials, then you get inflation.
And as long as there's slack in the economy, as long as there's idle capacity, the government can spend without worrying about inflation.
That's the theory. And you can see why it's so controversial. The source material we looked at points out that MMT is, and I'm quoting here, disregarded by respected economists.
Why such a strong reaction?
Well, the mainstream critique tends to divide MMT's claims into two categories.
What's the first one?
The first is what they call correct but obvious or useless.
Meaning?
Meaning, yes, mainstream economists agree that technically the U.S. government can't be forced to default. It has the legal power to create dollars to pay its debts. That's not a new insight.
The Federal Reserve can literally create money.
Right. But the critique is that knowing you can do something doesn't mean you should. The real question isn't about technical capability, it's about the consequences.
Which brings us to the second category of critique. Fantastic, but false or dangerous.
Exactly. This is the core of the disagreement. Mainstream economics argues that the mechanism MMT proposes funding deficits directly by creating new money is a recipe for disaster. It leads to massive, runaway, and permanent inflation.
What is MMT's proposed solution for when inflation does show up?
This is where it gets even more radical. Their answer is taxes. If the economy overheats, the government should just impose huge tax hikes to pull money out of the system and cool down demand.
And the mainstream view is that this is politically unrealistic.
That's putting it mildly. The argument is that it's politically very easy for a government to spend new money on popular programs, but it is political suicide to then impose massive, painful tax hikes on the public to rein in the resulting inflation.
The incentives are all wrong.
Completely. One of our sources uses a really powerful analogy. It says that MMT claiming we don't have to worry about debt because we can print money is like saying being trapped on a burning building roof is fine because you can always jump to your death.
The option exists, but it's not a solution.
It's a catastrophic trade-off. And the real deep danger that MMT ignores, or at least downplays, is the importance of central bank independence.
Explain that. Why is keeping the central bank independent from the government so critical in the mainstream view?
The current system we have in most developed economies was built on the painful lessons of the 1970s and 80s when inflation was out of control. The solution was to create a firewall. You insulate the central bank, the institution that controls the money supply, from short-term political pressure.
So the Fed, or the European Central Bank, has one job: keep inflation low and stable, usually around a 2% target, regardless of which political party is in power.
Right. They can make unpopular decisions like raising interest rates to slow the economy because they don't have to worry about the next election. MMT effectively tears down that firewall. It merges the Treasury, which is the fiscal arm of the government, with the central bank.
It puts politicians directly in charge of the printing press.
And history is just littered with examples of what happens when that occurs. Politicians have short-term incentives. They want to fund projects and win elections. The temptation to just create money to pay for everything without making the hard choice of raising taxes or cutting spending becomes irresistible.
And that path leads directly to high and volatile inflation.
It's the classic trade-off. By adopting an MMT-like framework, you might gain the technical ability to fund any program you want, but you sacrifice the institutional anchor that provides low and stable inflation. You give up a predictable economic environment for a much higher risk of chaos.
So if MMT represents the theory of pushing the money printing limit, It seems we need a real-world example of what happens when that limit is not just pushed, but completely obliterated.
And for that, we have to turn to the tragic and cautionary tale of Venezuela. It's a modern, quantifiable case study of what happens when the MMT mechanism is embraced without restraint.
The country experienced a brutal period of hyperinflation. Let's start with the definition. What technically counts as hyperinflation?
The classic definition comes from an economist named Philip Kagan back in 1956. He defined it as a period where the monthly inflation rate exceeds 50%. 50.
And how long did Venezuela's episode last?
It was one of the longest in Latin American history. It ran for 26 straight months, from December of 2017 to January of 2020. And over that period, the average monthly inflation rate was a mind-boggling 67.4%.
Well, let that sink in. Prices weren't just doubling every year, they were going up by 2/3 every single month.
Your life savings could be wiped out in a matter of weeks. The economic destruction is almost total.
So what was the direct cause? Was it a complex mix of factors, or was it really about the money supply, just like the classical QTM would predict?
The evidence is overwhelming. The source material shows it was fundamentally caused by the financing of the government's massive fiscal deficit through an equally massive expansion of the monetary base by the Central Bank of Venezuela.
And this wasn't an accident. It was enabled by a specific policy change.
Yes. A crucial legal reform in 2009 gave the central bank the power to directly buy securities from the state oil company, PDVSA. In effect, this gave the government a direct line to the printing press. It could fund its budget deficits by simply having the central bank create the money.
This is the exact mechanism MMT critics warn about. The firewall was gone. So what did the numbers look like once that started?
The printing went into overdrive. The average monthly growth rate of the monetary base was an astronomical 55.7%.
55% more money created every single month.
And when you correlate that number with the inflation rate, the coefficient is 0.77. That is an incredibly strong statistical link. It's about as close to a smoking gun as you get in economics. The expansion of the quantity of money was without a doubt the primary driver.
But it's not just about the supply of money, is it? The hyperinflation also dramatically changed how people behaved. It changed the demand for money.
It absolutely did. This is where the behavioral side, the Cambridge K, comes back in a terrifying way. As prices spiral out of control, people realize that the currency in their pocket is melting like an ice cube.
It becomes a hot potato. You want to get rid of it as fast as possible.
Instantly. You get your paycheck and you run to the store to buy anything at all that holds value because you know by tomorrow your money will be worth significantly less.
So the Cambridge K, the desire to hold cash, collapses to near zero.
It does. And that means the velocity of money, V, goes through the stratosphere. And here's the frightening feedback loop. When velocity spikes like that, prices actually start increasing faster than the money supply itself. The panic accelerates the inflation beyond the rate of printing.
It sounds like pure chaos. Did the public's demand for money just become completely erratic and unpredictable?
That's a key question, and the econometric analysis in our sources provides a fascinating answer. Even amidst all that chaos and panic, Kagan's framework shows that the demand for money remained dynamically stable.
What does that mean?
It means it wasn't random. The public's desire to flee the currency followed a predictable mathematical pattern based on their expectations of future inflation, which in turn were driven by the rate of monetary expansion. This is a crucial scientific finding.
Why is it so important?
Because it proves the hyperinflation wasn't just a self-fulfilling psychological panic. It was a predictable, rational response to a single, overwhelming cause: the government's decision to relentlessly expand the money supply. The QTM, in this extreme case, holds with devastating precision.
And as the local currency, the bolivar, was destroyed, something else rushed in to fill the void.
The US dollar. You saw massive informal dollarization. This is a classic example of what's called Thier's law.
Yeah.
Good money drives out bad. When the state-issued money fails in its basic functions, people will find an alternative that works as a store of value and medium of exchange.
And this was accelerated by the massive wave of emigration from the country.
Yes. The diaspora was huge, and they began sending remittances back home in dollars. This increased the physical supply of dollars within Venezuela, making it the de facto currency for many transactions and further cementing its role.
The sources also point out a very strange and atypical behavior with the exchange rate during this period. What was that?
It was very counterintuitive. Normally, in a hyperinflation, the local currency depreciates on foreign exchange markets even faster than domestic prices are rising. But in Venezuela, for a time, the opposite happened. The nominal exchange rate depreciation actually lagged behind the domestic inflation rate.
Which means the real exchange rate actually appreciated for a while. That makes no sense.
It seems bizarre, but the theory is that the sheer volume of dollar remittances coming in from the diaspora was so large that it created a constant supply of dollars, propping up the bolivar's value on the black market relative to what it should have been given the inflation. It's a sign of just how distorted the economy had become.
So the final inescapable lesson from Venezuela is what?
It's twofold. First, it's absolute proof that if you abandon all fiscal and monetary discipline, the quantity theory of money will assert itself with brutal force. Second, it shows that the way out, while painful, is clear. A drastic reduction in the rate of money growth will eventually bring inflation down.
But that's not a permanent fix.
No. For the fix to be sustainable, you have to rebuild the institutional firewall. You need comprehensive fiscal and monetary reforms that permanently separate the government's wallet from the central bank's printing press.
Okay, we've seen the theory fail in the short run with Keynes. We've seen it succeed with terrifying force in Venezuela. Let's come back to the modern developed world and talk about the complex tool they use in a crisis, quantitative easing or QE.
Right. This was the signature policy response to the 2008 financial crisis and again during the pandemic, and it sits in a very murky area of this money printing debate.
Let's start with a simple definition. What is QE?
At its core, QE is when a central bank, like the Fed, creates new money to buy financial assets, usually long-term government bonds, from commercial banks.
Wait, creates new money to buy things. That sounds exactly like what we were just talking about.
It sounds like it, and it is a form of money creation. But proponents of QE stress a very important mechanical difference between QE and the kind of reckless printing that causes hyperinflation.
And that difference is?
It's all about where the new money goes. When Venezuela was printing money, it was essentially funding the government, and that money went straight into the real economy to pay salaries or fund projects. QE, on the other hand, primarily increases bank reserves.
Okay, explain that distinction. Why is creating reserves different from creating cash?
When the Fed buys $1 billion of bonds from, say, Bank of America, it doesn't drop off a pallet of cash. It simply credits Bank of America's reserve account at the Fed with $1 billion. These reserves are electronic ledger entries.
So they're not circulating in the real economy. They're stuck inside the banking system.
Initially, yes. The idea is that with all these new reserves, banks will feel safer and be encouraged to lend more money to businesses and consumers. That's how it's supposed to stimulate the economy. But the money doesn't get out unless the banks actually lend it.
So you can lead a horse to water. This brings back the Keynesian liquidity trap idea.
It's the modern version of it, and this is one of the biggest risks of QE. What if you create all these reserves, but the banks are too nervous to lend, they just hoard them?
Which is exactly what happened after 2008.
Right. It is. The sources note that U.S. banks ended up sitting on about $2.8 trillion in excess reserves. Money the Fed had created to stimulate the economy that never actually left the banking system's vaults.
Which explains why QE 1, 2, and 3 didn't cause the immediate inflation many people feared.
Exactly. The velocity of that new money was effectively zero.
So hoarded reserves is one risk. What are the other dangers of relying on QE?
Well, there's still the classic inflation risk. It might not be immediate, but that money is now in the system. The source material suggests a typical lag of 12 to 18 months before a monetary expansion might start to show up in prices.
And the third risk?
Currency devaluation. By massively increasing the supply of your currency, you tend to lower its value relative to other currencies.
Which can be good for your exporters, but bad for anyone who needs to import things.
Right. For the U.S., a weaker dollar makes Boeing jets cheaper for foreign airlines. But it also makes imported oil, electronics, and raw materials more expensive for American consumers and factories. It can be a source of that cost-push inflation we talked about earlier.
So with all these complexities and risks, what's the verdict from the real world? Did QE actually work?
The results are decidedly mixed. In the U.S. after 2008, QE is widely credited with stabilizing the financial markets and preventing a full-blown depression. That's a huge win. But its ability to generate a strong, robust recovery was clearly limited by that reserve hoarding problem.
What about elsewhere? Japan has been the poster child for QE for decades.
And their experience is even more complex. The Bank of Japan has used some of the most aggressive QE programs in history since their crisis in the late 90s. And while they've sometimes achieved temporary positive effects, the economy has consistently struggled to achieve sustained growth or to escape deflation.
And the UK after Brexit.
There, the sources say economists found it almost impossible to prove a causal link. They couldn't say with any certainty whether the growth that occurred would have happened anyway without the QE program.
So it seems like modern central banks are using these incredibly powerful tools, but the results are often ambiguous and hard to predict.
It highlights just how complex the transmission mechanisms are. It's not a simple lever you pull.
This brings us to our final piece of evidence, which is a fantastic reality check, especially for developing countries. It's a study that looked at 5 major emerging economies over 2 decades.
Yes, a panel data study from 1995 to 2017, looking at Turkey, India, Brazil, Indonesia, and China, trying to figure out what really drives their inflation.
And what did it find? Did the quantity theory of money hold up?
It did, but only partially. The study confirmed that the monetary link is real. Across the board, a 1% increase in the growth of the M2 money supply led to a 0.7% increase in inflation.
So money matters. More money does lead to more inflation, all else being equal.
The link is there, it's positive, and it's statistically significant in the long run. But, and this is a huge but, that was not the main story.
What was the main story?
The study's major conclusion was that inflation in these developing nations is driven far more by real factors than by purely monetary ones.
By things like supply shocks and structural problems in the economy.
Exactly. And the numbers they found are just astonishing. Remember, a 1% increase in money supply growth led to 0.7% inflation. The study also found that a 1% drop in real income, which is often a sign of a production shortfall, or a supply shock increased inflation by a massive 3.6%.
Wow. So 3.6 versus 0.7.
Right. The impact of a real shock to the supply side of the economy was more than 5 times as powerful as the impact from the growth of the money supply itself.
That is a critical finding for policymakers in those countries.
It's everything. It tells them that their inflation problem is not primarily a monetary one. It's a structural one. It comes from supply chain weaknesses, infrastructure deficits, exchange rate volatility, and other real constraints on their ability to produce.
So trying to fight inflation just by tightening the money supply, while it's a necessary piece of the puzzle,
It's completely insufficient. If you're not also addressing the underlying supply-side problems, you'll never get inflation under control in a sustainable way. You have to coordinate production policy with monetary discipline.
an incredibly important and nuanced conclusion.
It really is. It shows that applying the simple, rigid QTM model to the complex reality of a modern, globalized, developing economy is just, well, it's fundamentally inadequate.
So after this whole journey, what does this all mean? We've gone from a simple classical rule from the 16th century to the messy, nuanced reality of the 21st.
I think the big synthesis is that everything is conditional. That old phrase, money supply alone causes inflation, is true, but only under very specific conditions.
It's undeniably true in the long run, and it's brutally true during a hyperinflationary spiral like Venezuela's.
Exactly. In those cases, the monetary factor is so overwhelming it drowns out everything else. But in the short run, in a normal economy, and especially in developing economies, the picture is so much more complicated.
The structure of the economy, the supply shocks, the cost pressures, currency movements, those often become the more immediate and critical drivers.
And the money supply acts more as an amplifier, or as fuel for a fire that was started by something else entirely. It's rarely the single origin point.
And the one variable that seems to pop up at every stage of this story, from Cambridge in the early 1900s to the pandemic in 2020, is that unpredictable human element, the velocity of money.
That's right. The rate at which we choose to spend or hoard our cash. The entire stability of the classical system depends on that variable being stable, but we've seen again and again that it's anything but.
Which leads us to the final provocative thought we want to leave you with.
We now live in an increasingly digital world. We have immediate payment apps, digital currencies, contactless everything. Money moves faster and more frictionlessly than ever before.
A world where money almost never sits idle in a physical wallet.
So the question is this. As this trend continues, will it drastically, and perhaps uncontrollably, change the underlying velocity of money for the entire economy?
And if V becomes hyper-efficient, but also hyper-volatile in a fully digitized world, could that render the traditional tools of a central bank, like tweaking interest rates, much less effective?
Could it force policymakers to rely even more heavily on those much harder, more painful tools like direct fiscal policy and supply-side interventions just to keep prices stable? It really asks if our technology is about to outrun our economic models.
A fascinating and maybe slightly unnerving question to end on. The link between the numbers on your screen and the prices you pay is more complex and maybe more fragile than we ever thought.
So we encourage you to keep questioning the simple answers.
Thank you for joining us for this deep dive into the money supply mystery. We hope it's given you a new lens through which to view the economic headlines. Until next time.